The S&P 500, the bellwether of the American stock market, has rallied nearly 10% over the past 3 weeks, following a dismal January and February. 3 weeks ago, the index looked like it was about to give up the ghost. And now, unbelievably, it is just 5% away from its all-time high. The renewed confidence in the U.S. stock market appears to have been inspired by the belief that the conflict in Ukraine will be short-lived, and that anyway, the U.S. will be relatively immune to its impact. This is why the U.S. stock market has outperformed the stock markets of the rest of the world by 10% since Russia invaded Ukraine, and why the U.S. dollar has likewise outperformed nearly every major currency in the world, including safe havens like the Japanese yen and the Swiss franc. Is the market right to assume that the US will ride out the Russia-Ukraine war better than anyone else? Is the big rally in US stocks supported by US fundamentals? Or is it just a dead cat bounce? Hi, my name is David Wu, a former Wall Street global macro strategist with a 20-year track record of making actionable predictions about big global events. Welcome to part 1 of The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. In today's video, I will talk about why I think the stock market is wrong to assume the US economy will be resilient to the war. I will argue why the recent stock market rally is unsustainable, especially if Washington fails to pull off a regime change in Moscow soon. The war started in late February. Last week, we got the first batch of US economic data for March, the first full month after Russia's tank rolled into Ukraine. What does the data tell us about the U.S. economic response to the war so far? The new orders component of an important survey of purchasing managers in the manufacturing sector, an excellent leading indicator of the U.S. business cycle, fell sharply to the lowest level in 2 years. This is consistent with reports that Apple is cutting production of the iPhone SE by 20% next quarter. Meanwhile, a widely followed U.S. consumer survey showed a sharp drop of consumer confidence in March to the lowest level in more than 10 years. Last week, we also got the preliminary estimates of U.S. corporate income data for the end of 2021. It shows that even before there was even a hint of a war coming, the growth rate of U.S. corporate earnings had already gone to 0. And yet, the data also shows that corporate profit margin at about 15% was still very high, near the highest level in 20 years. Profit margin measures what companies charge for the goods and services they produce versus what they have to pay for producing these goods and services. The question is whether this fat profit margin, 15%, is sustainable. Looking at different factors, I think not. Let's examine first the revenue side of the equation. The pricing power of corporate America got a huge boost last year from the massive handouts to U.S. households by the Biden administration that sent Americans on a once-in-a-generation shopping spree. Consumer demand was so strong that companies had no problem passing higher costs to their customers. On the cost side of the equation, the price of industrial raw materials continues its relentless rise, pressuring the margins of a wide range of manufacturers from car companies to detergent producers. The CRB Raw Industrials Index, that includes everything from cotton to rubber to steel, has been rising at an annualized rate of 24% so far this year. The cost of labor, which is about 60% of the overall cost for average American corporations, but higher for service providers, is rising at a rate of 6%, the fastest in 20 years. With 10 million unfilled jobs and the unemployment rate now at just 3.6%, workers are regaining their wage bargaining power. Last week, the workers at Amazon's Staten Island facility made history, voting to become the first unionized U.S. facility operated by the largest e-commerce company in the world. Amazon will fight the decision, but this looks like a broader trend that is here to stay. This is undoubtedly bad news for Amazon's corporate profit margins. Meanwhile, the interest cost for financing and refinancing long-term debt is going up quickly. This will also pressure corporate profit margins. Some banks have even started to tighten lending standards. I can only assume, based on the above factors, that U.S. corporate profit margin has likely peaked. It seems reasonable to think that it will at least fall back to the pre-pandemic level. This will represent a 2.5 percentage point drop. And if this happens rapidly, we could see a 15% drop in corporate earnings. This does not even assume we go into a recession and revenue drops. Yet the consensus on Wall Street is that while earnings growth will slow this year, it will still clock a respectable growth rate of 9% on a post-COVID bounce in demand. In my view, Wall Street is drinking its own Kool-Aid. The only way Wall Street analysts could be right is if the war in Ukraine ends soon and the sanctions against Russia are rolled back immediately. But as I've argued in last week's program, is Putin done for? I believe that the war in Ukraine will not end anytime soon. While Washington is aiming to achieve a regime change in Moscow, Putin's decision to pull back from Kiev signals that he's planning to dig in the east for an extended conflict. In fact, the latest reading from the Unbound military conflict risk survey shows that 70% of Russians and 60% of Ukrainians think that military tension is likely to either remain the same or intensify. In any event, the impact of the war on the U.S. economy comes not from the fighting on the ground, but from the sanctions. Even if the fighting were to cease, as long as the sanctions remain in place, the economic pain for the rest of the world, including the U.S., will not end. The most important headwind from the war for the U.S. economy is the increase in oil price that is sapping consumer confidence and consumers' real purchasing power. Last week, Biden decided to deal with this headwind by releasing 150 million barrels of oil from the U.S. Strategic Reserve over the next 6 months. This is an unprecedented move. But will this be sufficient to support corporate profit margins in the U.S. stock market? In my view, Biden's move is unlikely to have a sustainable impact on the oil price. The timing as well is indicative, as it could be telling us that the U.S.-Iran nuclear negotiations are not going well. Releasing the U.S. reserve will also strengthen OPEC plus incentive not to increase production more quickly. The longer the war drags on, the impact on the U.S. economy, on U.S. corporate profit margins will become more visible. I don't see the war ending in the near horizon. I certainly don't see the U.S. removing sanctions on Russia anytime soon. To the contrary, the evidence at hand suggests that the conflict is intensifying and broadening, with growing risk that China will be dragged in. Against this backdrop, I think Wall Street will be soon forced to revise down its forecast for both the U.S. economy and the U.S. corporate profit outlook. My expectation is that the forthcoming U.S. corporate earnings season could provide the catalyst for this. If I'm right, April will not be kind for S&P 500. If you've enjoyed this program, please hit like and subscribe to my YouTube channel. If you want to watch the second part of this program, in which I discuss my investment strategy, including how to use bonds and currencies and stocks to position for this macro theme as well as others, please come visit us at davidwuunbound.com. Thank you for listening.